Professor. My team and I are going to present about Pacific Pipe Public Company Limited. These are my team members. These are the table of content. And moving to introduction, Pacific Pipe refers to Pacific Pipe Public Company Limited, a major type manufacturer and distributor of various steel pipe, established in 1972 under the initial name Tam Mong Seng Factory and originally producing toy car. The company expands into steel pipe production in 1991. It went public in 2004 and is now a leading provider of steel pipe for construction pipeline system, offering wide range of products.
Greeting Professor. Today we'll analyze the financial health and performance of the company over the past 3 years, focusing on liquidity and return on investment. This will help us understand the company operational efficiency, financial stability, and profitable trends. The current first is the liquidity ratio. The current ratio declined from 1.59 in 2021 to 1.3 in 2022, indicating reduced liquidity. A ratio above 1 is positive, but the drop suggests tighter cash flow management or increased liabilities. The collection period increased slightly from 33 days in 2021 to 35 days in 2022, showing slower receivable turnover. This could impact cash flow. Next is days to sell inventory. It improved significantly from 79 days in 2021 to 64 days in 2022, reflecting better inventory management or stronger sales. Next is return on investment analysis. Return on assets plummeted from 11.72% in 2021 to negative 3.96% in 2022. This suggested that assets are no longer generating profits, possibly due to rising costs or declining revenues. Next is the return on equity, dropped from 20.48% in 2021 to negative 13.48% in 2022, indicating severe pressure on shareholder value. Negative return on equity is a red flag for investors. This drastic shift from positive to negative returns signal potential operating challenges or
Good afternoon, Professor. Today I will be analyzing two financial aspects. It's the operating expense and the asset utilization. So first of all, operating expense reflected in profitability ratio. The gross profit margin showed the percentage of the revenue left after covering the production loss. In 2022, it significantly dropped from 11.4% to 0.14%, and signaling that there is severe cost pressure or pricing issues. And the operating profit margins pre-tax turned negative at negative 3.07% in 2022, down from 7.6%, indicating that there is rising overheads or declining sales efficiency. Similarly, the net profit margin falls from negative 3.42%, which is a sharp drop from 5.77% in 2022, this signaling that there is a decline, suggesting that the company struggled to control its expense or face external challenges which affect their profitability. Next, the asset utilization ratio. This measures how the effectively resources generated sales. The cash turnover increased slightly to 29.37 in 2022, showing that there's efficient cash use. However, account receivables turnover dipped to 10.4, hinting that there is a slower collection. Inventory turnover improved from 5.58, suggesting that there is a better stock management. Meanwhile, PPE turnover rose to 6.02, reflecting there is a stronger use of physical asset. The total asset turnover reached to 2.03, indicating there is overall resources efficiency. This mixed result highlight the strength of the inventory, PPE, and weakness of receivable. Thank you, and that's all for my part.
So next we have profit or loss vertical analysis. For the purpose of doing profit or loss vertical analysis is to help understand how each expense or profit component contributes to the total revenue. So we have cost of sales, total expenses, operating profit or loss, and profit or loss. And we can compare each of this year. For cost of sales, there is a increase from 2022 if we compare to 2021 and 2020. For total expenses and for total expenses there is also an increase, and then for operating profit or loss and profit or loss there is a decrease in 2022 compared to 2021 and 2020. For financial position vertical analysis, for financial position vertical analysis, it shows the relative size of each asset, liability, and equity item compared to the whole financial position. So here we have cash and cash equivalent, total current assets, total non-current assets, and total assets. And to get all of these answers, we need to take each of the amounts in each year to divide it by total assets. And we can see we can compare each of this year. There is also increase and there is also a decrease. So overall, the business is doing pretty good of financial managing and strategic planning. Last but not least, we have another financial position, but it's about the total current liabilities and total liabilities, total shareholders' equity, and total liabilities and shareholders' equity. So to do all of these, we do the same thing. We need to take each of these three amounts of each year to divide it by the total liabilities and the shareholders' equity. And there's also a decrease and also increase in each of the year. So overall, both liabilities and equity increase over years with a notable rise in current liabilities and in 2022. So this reflects more aggressive approach to financing, but also a commitment to growing equity base. And this is all for my part. Let's move on to next presenter.
So next, let's move on to the horizontal analysis of profit or loss horizontal analysis, and the second is financial positions horizontal analysis. And I will be cover the first one of profit or loss horizontal analysis. And as we have 2020 as the best year of figures at 100%, which we take it to compare to other years. First, the cost of sale it's increased significantly over the 3 years from 100% in 2020 to 128.26% in 2021, and then also up to 146.7% 2022. It reflects a sharp increase in raw material costs, particularly steel price, which is a major cost for passive price. It also suggests that the supply chains challenge or lower production efficiency in 2022. About the total expense showed similar trends and in 100% in 2020, and then rising to 126.6% in 2021, and then it further to 143% in 2022. This indicates the higher operations cost overall, possibly due to the inflation, logistic cost, or the increased staff expense. And now looking at the operations profit or loss, in 2020 it remained 100% and then also rose to 251%, and then it dropped down to the minus 103% in 2020, showing the operation loss. This could be due to the declining demands or overspending that wasn't often offset by revenue. So finally, the profit or loss is also similar to the operations profit, since in 2020 it's 100% and then rose to 273.23% in 2021, and then And then in 2022, the profit and loss it dropped down to minus 165%, indicating net loss, likely the result of both rising costs and falling sale or pricing pressures. So overall, while 2021 was a peak year for the profits, in 2022 it reflects the serious financial pressures and call for better cost management and market the adoptions. And that's all for my presentation. Let's move on to the next presenter. Greeting Professor. Now I'm going to cover about the financial position, horizontal analysis. So now let's start with the assets of 2020 to 2022. In 2021, the cash has increased a lot, up to 154%. This means that the company had money on hand, maybe to be sold during the uncertain times. And for the total current assets, it also increased a lot in 2021 to 175%, but then it dropped down to 95% in 2022. This means that they sold less or collect less from customer. For the total non-current assets, like the building, the machines, it slowly went down to 94.75% in 2021 and still dropped down to 88.42% in 2022 again, due to the depreciation of the values of the machine, the equipment, or they're spending less on the new investment as well. And as the result, the total asset dropped to 92.84% in 2022. So the company had fewer resources, maybe becoming a smaller or more careful with the spending. Now let's move to looking at the financial position about the liability and equity. The current liability went up to 124.84% in 2021, but then it dropped to 108% in 2022. This might mean that they paid off some short-term debt, and total liability followed the same patterns up to 121.65% in 2021. Then it decreased to 105% in 2022. So the company is slowly reducing its debt. And shareholder equities higher in 2021, about 119.37%, but then it dropped down to 92.84% in 2022 again. This could mean that this could be about the losing money or paying out more in dividends than they earned. And in total liability and equities, much the drop in the total assets also ending at the 92.84% in 2022. This show the company is possibly training a bit or going through the change because of the economy or their own financial decisions. So this is all for my presentation. So now let's move to the final presentation.
Conclusion. The vertical analysis revealed a shift toward long-term investment with non-current asset rising while current asset declined to 62.08% in 2022. Liability and equity remain balanced at 51.52%. But the increase in current liability signal higher short-term obligation. To ensure stability, the company should optimize working capital and strengthen equity. Recommendation: optimizing cost management without sacrificing equity or production directly. Tackle PAP, profitable issue. It will boost net profit margin. by reducing cost of goods sold and operation expense, enhance competitiveness through flexible price, improving cash flow by reducing working capital needs and leads to better resource utilizing and data-driven decision. Next, management money flow. They need to tighten up how they handle their day-to-day cash. This involves optimizing their inventory turnover to avoid tying up too much cash in stock, getting paid faster by customer and carefully managing what they own to suppliers. Lastly, cost management and operational control focus on bringing down their cost of goods sold and operating expense. This means looking at every step of their production process to eliminate waste, getting better deals and raw material through strategic purchasing and investing in process improvement that lower per unit cost. That's all for my team. Thank you for your attention.